Hello, Blue Nation. Welcome back to our weekly series, Investing in Tipton's Future. Today, we're taking a closer look at an important topic: how Indiana's tax caps and the new changes in Senate Enrolled Act 1 impact your property tax bill here in Tipton. This topic can get complicated, so we'll walk through it step by step. Our goal is to help you understand how the new tax laws impact both your property tax bill and the funding available to our schools. First, what do we mean by a tax cap? A tax cap is a legal limit on how much property owners can be taxed based on the assessed value of their property. In 2007, tax caps were instituted in response to rapidly rising property taxes. The state government wanted predictability and protection for property owners. Tax caps, sometimes referred to as circuit breakers, prevent taxes from growing out of control due to sudden increases in property's assessed value. For the property that serves as your primary home, there is a limit on how large your property tax bill can be, based on its assessed value. For a homestead, your primary residence, the cap is 1% of the assessed value. For farmland or rental property, the tax cap is 2%, and for commercial property, the tax cap is 3%. These tax caps help provide predictability and a ceiling to what you might owe. However, there are important exceptions that can raise amounts above the cap, such as voter approved excess levies or operating referenda. So, what exactly is assessed value and how is it determined? Your assessed value is the amount the Tipton County Assessor decides your property is worth for tax purposes. This includes both the land you own and anything built on it, like your house, garage, or barn. It's not necessarily what you could sell your house for, but rather a value used to calculate how much you owe in property taxes. Let's say the Tipton County Assessor evaluates your home property at $200,000. To determine what you owe in taxes, start with the property's gross assessed value, which is basically the full value of your property before any deductions. Then, subtract any deductions or exemptions you qualify for, like the homestead deduction or mortgage deduction, to get your net assessed value. That net assessed value is what your property taxes are actually based on. For example, let's say a home in Tipton is assessed at $200,000. That's the gross assessed value. If the homeowner qualifies for typical deductions totaling $99,250, the net assessed value drops to just $100,750. The homeowner's property taxes will then be calculated on that $100,750 amount, not the full $200,000. In this example, the homeowner's tax liability is capped at $1,007.50. And because every area inside Tipton Community Schools has a tax rate that exceeds the 1% threshold, the cap becomes the actual tax bill. In other words, the printed tax rate might be over 3%, but the cap stops the bill from rising above 1% of your home's net assessed value. This process helps ensure that every property in Tipton County is treated fairly and consistently when it comes to taxes. I want to walk you through a really important point about how property taxes work for homeowners in Tipton Community Schools. These numbers on the screen show the full tax rate for each township and town inside our school district. If there were no caps, a $200,000 home would be paying anywhere from about $1,400 in rural townships to more than $3,600 inside the city of Tipton. But again, thanks to property tax caps, that is not what homeowners pay. Indiana's 1% homestead tax cap acts like a hard stop sign. No matter what the published tax rate is, whether it's 1.4%, 2.5%, or over 3.6%, the tax bill for a primary residence can exceed that 1% of the home's net assessed value. As we discussed in our example home in Tipton, that cap is $1,007.50. And as you can see, every single area inside our school district has a rate that would exceed that amount if caps didn't exist. So even though homeowners see a tax rate printed on their bill that feels high, their actual tax bill is lower, much lower, because the cap protects them. The important community impact is this: everything above the 1% limit becomes circuit breaker loss, which is revenue that local governments and the school district are legally prohibited from collecting without voter permission. Here's where recent changes under Senate Enrolled Act 1 come in. The law changes how some deductions and relief programs apply, which in turn affects how much of your assessed value is taxable. For instance, the standard homestead deduction for owner-occupied homes is being phased down beginning with the 2025 assessment for taxes payable in 2026. But most of the changes become more visible between 2027 and 2031, with the new percent deduction increasing. Additionally, Senate Enroll Act 1 begins an annual homestead tax credit of 10% of your property tax liability, or $300, whichever one is lower. This provides further tax relief for homeowners. Basically, under the old rules, you got a large fixed deduction plus a percentage-based deduction. Under Senate Enrolled Act 1, the fixed deduction is phased out, but a larger percentage deduction is phased in, with an additional tax credit tagged on to that final bill, ultimately leading to greater tax breaks. Let's take our same example home with a gross assessed value of $200,000. In 2024, before Senate Enrolled Act 1, the net assessed value after deductions would be about $100,750, which puts the 1% tax cap just over $1,000. Under Senate Enrolled Act 1 in 2031, with the new deduction structure fully in place, that same home's net assessed value falls to about $66,600, making the 1% tax cap just about $667. Senate Enrolled Act 1 also adds a brand new tax credit for homeowners. Again, that 10% of your tax bill up to $300. When we apply that credit, it reduces the homeowner's actual payment from $667 down to just $600 flat. From the homeowner perspective, that's welcome relief, but it also means that for each such home, the local tax entities lose roughly $400 in potential tax revenue. Multiply that across all homes in Tipton County, and you see how the tax base shrinks, meaning fewer dollars available for our schools, roads, emergency services, and other community priorities. To summarize, for homeowners living in their primary residence, the 1% cap continues to limit your property taxes, and that safeguard remains in place. What is changing, though, is how much total revenue our community, including schools, emergency services, and local government, can collect. Lower net assessed values mean there is simply less taxable property value to fund the services our community relies on. For Tipton schools, that impacts the operations fund, the dollars that pay for transportation, maintenance, utilities, and safety. Thanks for joining us for this week's installment of our Investing in Tipton's Future video series. As always, if you have any specific questions or topic requests, please reach out to me or Dr. Glaze. You can also find more resources and our video playlists on our district website under the Future Focus tab. Our next episode will look at how Senate Enrolled Act 1 impacts our farmland property taxes. Thank you for your time. We'll see you in the next installment of Investing in Tipton's Future.